Let's just dive right into this explainer. What if I told you the ultimate secret to absolutely crushing the stock market is to just completely ignore it? Seriously. Right now, millions of investors are literally bleeding money because they're treating Wall Street like a giant casino, just frantically reacting to every single red and green flash on a screen. But today we're unpacking a massive paradigm shift. We're looking at exactly what happens to your wealth the second you stop buying abstract ticker symbols and start buying fractional shares of real, living, breathing businesses.
Sounds totally backwards, right? But hey, this is exactly, and I mean exactly, how Warren Buffett built a fortune of over $100 billion. And got this, he didn't do it with some super secret Wall Street algorithm. He didn't have a crystal ball for macroeconomic trends. He actually proves that you can completely step outside that whole frenetic, chaotic market rat race and still win big. So, in this explainer, we're breaking down the exact, real-world principles from Robert G. Hagstrom's book, The Warren Buffett Way. And the whole shebang really starts with this one legendary quote: "Price is what you pay, value is what you get." The core thesis behind Buffett's unbelievable track record. It's that he wins not because of some raw, unmatched intelligence, but through just immense patience, totally rock-solid emotional discipline, and a highly rational business owner mindset. He doesn't look at a stock and think, where's this price going to be in a month? No, he looks at a business and asks, what is the true intrinsic value of this company today? And can I buy it on sale? So, the absolutely crucial thing to grasp here is this massive psychological shift. Most people out there are approaching the stock market using System 1 thinking. It's fast, it's reactionary, it's deeply, deeply emotional, basically built on intuition and, well, panic. Buffett, on the other hand, operates entirely in System 2. It's slow, it's deliberate, it's hyper-rational. And why this matters so much for you is that adopting System 2 thinking literally frees you from that exhausting day-to-day pressure of trying to predict market moves. You really don't have to be a genius to succeed, you just have to be rational. Now, to build that incredibly rational System 2 mindset, Buffett actually stood on the shoulders of 4 giants. He learned the all-important margin of safety from Ben Graham. Then Phil Fisher taught him focus investing and how to look really deeply into a company's management. John Burr Williams, he gave him the actual mathematical model for calculating true value. And of course, his longtime partner, Charlie Munger, helped him see the massive economic returns that come from paying up for truly great businesses, rather than just scraping the barrel for mediocre ones at a discount. So really, Buffett's genius is the brilliant synthesis of these 4 very distinct philosophies. Okay, moving into Section 1, the Owner's Manual, focusing on the 12 business tenets. Let's see how all of this builds into an actual, actionable framework. Buffett uses a strict set of 12 tenets to basically filter out all the Wall Street noise. And keep in mind, he applies these exact same tenets whether he's buying 100 shares of a company or buying out the entire corporation lock, stock, and barrel. Because to him, those are the exact same thing. First up in the framework are the business tenets. He asks, is this business simple? Is it understandable? Does it have a consistent operating history, or is it just constantly pivoting and reinventing itself? And crucially, does it have a moat, a real competitive advantage protecting it from rivals? Why this matters right now is because it gives you a highly tangible, real-world checklist. It forces you to stay inside your circle of competence. Seriously, if you don't actually understand how a company makes its money, you have absolutely no business buying its stock. Next up, he looks at the people actually running the show with the management tenets. Are they being rational with the company's cash? Are they candid and honest when they make mistakes? And most importantly, do they resist the institutional imperative? That's Buffett's special term for when corporate managers just blindly follow their industry peers, literally like lemmings off a cliff, just because everyone else is doing it. You absolutely must demand that leaders act like true owners. Then we dive into the financial tenets. While everyone else on Wall Street is obsessing over short-term earnings per share, Buffett just completely ignores all that accounting trickery. He looks closely at return on equity, he hunts for high profit margins, he makes sure that for every single dollar a company retains, they're actually creating at least $1 of market value. But the big one, the most important piece, is calculating what he calls owner earnings. And this completely nails that concept. On the surface, those solid black bars show a company's net income steadily going up, up, up. Looks great, right? But then look at the striped bars. Those represent the true owner earnings. That's the actual cash flow left over after the business pays for all the essential capital expenditures it needs just to keep the lights on.
A lot of companies look super profitable on paper, but when you check their real owner earnings, you realize they're just burning through cash just to survive. This right here is exactly why you have to look deeper.
All right, Section 2, calculating true value and protecting your downside. So once you've actually found a phenomenal business with great management and rock-solid financials, you move to this critical step. This is where you figure out what the company is actually worth, completely independent of what the stock market ticker is flashing. This brings us straight to Ben Graham's ultimate rule, the margin of safety. Basically, this is just the gap between what a business is actually worth and the price it's currently trading at. And why does this matter so much? Because guys, this is your ultimate downside protection. If you crunch the numbers and find a company is worth $50 a share, but you can snag it on sale for $30, you've got a massive margin of safety. Even if your calculations are a little bit off or the economy takes a sudden nosedive, you are heavily protected from a catastrophic loss. So how do we actually find that magic intrinsic value? Well, Buffett uses John Burr Williams' discounted cash flow model. I know, it sounds super academic, but the logic is actually incredibly simple. Williams put it like this. You value a cow for her milk, you value a hen for her eggs, and you value a stock for the cash it's going to generate over its lifetime. It's just about estimating the cash that business will pump out into the future and discounting it back to what it's worth today. Moving right along to Section 3, the psychology of money and becoming a focus investor. Now, what's really fascinating here is how we take these cold, logical valuations and apply them in a world that is frankly deeply illogical. Because finding the value of a company is only half the battle. The other half, surviving the intense, totally wild psychological roller coaster of the financial markets. To handle this, Buffett leans heavily on Ben Graham's incredibly famous allegory of Mr. Market. Picture this. You're business partners with a highly manic depressive guy named Mr. Market. Every single day, he knocks on your door offering to buy your share or sell you hits. Some days, he's completely euphoric, offering you absurdly high prices. Other days, he's totally depressed, willing to sell you his share for literally pennies on the dollar. Really understanding Mr. Market changes everything. It completely rewires your brain to view market crashes not as some crisis you need to panic over, but as a rare, incredible opportunity to buy amazing businesses from a very depressed Mr. Market at a massive discount. Just look at Buffett's legendary investment in Coca-Cola. Back in 1988, Mr. Market was still completely reeling from the crash of '87. But Buffett just saw a simple, understandable business with an absolute fortress of a moat, trading at a huge discount to its intrinsic value. And because the odds were so overwhelmingly in his favor, he didn't just buy a little bit. He backed up the truck. He poured over $1 billion into Coke. And as you can plainly see, that single highly focused bet just completely crushed the S&P 500 in the years that followed.
That whole Coca-Cola play perfectly captures the core rules of focus investing. Buffett argues that if you genuinely understand what you're doing, hyper-diversifying your money into 50 or 100 different stocks makes absolutely zero sense. He actually calls that a Noah's Ark way of investing, where you just end up managing a zoo. Instead, the strategy is to concentrate on maybe 10 to 20 outstanding companies you truly, deeply understand, put the bulk of your money into your absolute highest conviction ideas, hold them for 5 to 10 years minimum, and just endure the volatility. Carry on.
We've covered a ton of ground here, but as we wrap up this explainer, we absolutely have to hit Section 4, the unreasonable man, the ultimate paradox. Because to succeed on the level of Warren Buffett, it really all boils down to your own temperament. You literally have to be willing to be what Wall Street would call an unreasonable man. You have to willingly, happily, ignore the frantic crowd. So here is the winning formula totally distilled. First, eliminate everything you can easily get wrong. That means trying to predict the economy, predicting the stock market, or trying to time your trades. Just stop. Second, focus all of your energy on what you actually can get right, valuing a good business. And finally, accept that true investors say no way more often than they say yes. Why this matters so much for you right now is simple. True wealth building isn't about having the highest IQ in the room. It's a massive exercise in emotional control. It's about independent thinking. It's about playing a completely different game than the loud speculators you see on TV. The reality is the stock market is there to serve you, not to instruct you. Every single day that bell rings, Mr. Market is going to be out there shouting out wildly irrational prices. So the only real question you have to answer is this. Will you have the patience, the sheer discipline, and the focus to just stand at the plate, tune out the noise, and wait for that perfect pitch? Take these tenets, apply them to your own portfolio, and just see what happens when you finally start investing like a true owner.